Microsoft and Amazon are spending enormous amounts of money on AI. After their reports, both stocks jumped. And Meta is also spending heavily on AI, but its stock fell. So the market isn't simply rewarding companies for spending more money on artificial intelligence. It's asking a much more important question: where is the return? But for investors, there is another question. Did these reports create a real buying opportunity, or did the market simply make already expensive stocks even more expensive? After updating my fair value models, these three companies may look very different from their stock price reactions. One may be closer to a reasonable entry price than it first appears. Another may offer very little room for disappointment, and the strongest report may not produce the best investment opportunity. In this video, I'll explain what really changed at Microsoft, Meta, and Amazon, what their reports mean for their fair values, and whether any of them moved closer to my buy price. To understand those valuations, we first need to see what actually changed inside each business. Let's start with Microsoft. Microsoft's report showed exactly what investors want to see from AI spending. The company is spending more money on data centers, chips, and cloud infrastructure. But customers are also paying to use that new capacity. Microsoft's total revenue grew by 18% to $90 billion. But the most important part of the report was Azure. Azure revenue grew by 43%. 1 year ago, Azure grew by 29%. So the growth rate didn't slow down as Microsoft became larger. It became much faster. That's important because Microsoft has already invested an enormous amount of money in AI infrastructure. And now we can see that customers actually want the new computing capacity. Microsoft Cloud revenue reached $59.3 billion and grew by 27%. The company also said demand was still higher than the amount of capacity it could provide. In simple words, Microsoft may have been able to grow even faster if it had more data centers ready. That makes the spending easier to understand. Microsoft isn't building everything and hoping that customers will arrive later. A large part of the demand is already there. And there was another important point. Microsoft is still producing a lot of cash. Free cash flow was around $19.6 billion during the quarter. It was lower than 1 year ago because capital spending increased, but it was still much stronger than the market expected. So Microsoft showed investors three things at the same time: fast cloud growth, strong demand, and a business that can still produce a lot of cash while spending heavily on AI. That is why the stock jumped after the report. It didn't rise only because Microsoft beat revenue or earnings expectation. It rose because investors got stronger proof that AI spending is already creating real business results. But as always, a great report and a great stock price aren't automatically the same thing. Microsoft is a good example for me personally. It's a business I would be comfortable owning for many years. But I still don't want the quality of the company to become an excuse for ignoring the valuation. As Warren Buffett once said, price is what you pay, value is what you get. And that is exactly why I separate the quality of the business from the price of the stock. At the time of recording, Microsoft was trading at around $489. My fair value today is around $430, and my 12 months base target is around $465. At this price, Microsoft looks moderately overvalued in my model. The stock is trading above my fair value today and even above my 12 months base target. The report improved my view of the business, but at the current price, I would still wait for a better entry. I don't own Microsoft today, but it's definitely one of the companies I may add to my portfolio in the future. If that happens, you will see the purchase in my public portfolio updates. Microsoft showed that huge AI spending can be justified when the return is already visible. But Meta also reported strong revenue growth and its stock still fell. The reason becomes clear when we look at expenses, margins, and cash flow. Meta's revenue grew by 28% to $60.8 billion. AI is already helping Meta improve recommendations, increase engagement, and show more relevant advertising. So it would be wrong to say that Meta is spending money on AI and getting nothing back. But the cost of that growth became the main problem. Meta's total expenses increased by 55%, so revenue grew by 28%, but expenses grew almost twice as fast, and we can see the result in operating margin. 1 year ago, Meta's operating margin was 43%. This quarter, it fell to 31%. Operating income also declined, even so revenue grew strongly. So Meta sold much more advertising, but it kept a smaller share of that revenue as operating profit. And cash flow made the problem even clearer. 1 year ago, Meta produced about $8.5 billion in free cash flow during the quarter. This time, free cash flow was only $784 million. That is a very large decline. And just to be clear, free cash flow is the cash left after the company pays for the investments needed to run and grow the business. Meta's operating business still produced a lot of cash, but most of that cash was used for data centers, AI infrastructure, and other investments. And this is where I start to worry. I understand the long-term idea behind the spending, but as an investor, I don't like depending only on the promise that the return will become clear later. And investors seem to have had the same concern. That's why the stock fell after the report. The key difference between Microsoft and Meta is how directly investors can see the return. Microsoft can sell cloud capacity directly to customers. When Azure demand grows, there is a clear link between AI infrastructure and new revenue. Meta mainly uses AI inside its own products. It can improve recommendations and advertising, but it's more difficult to separate how much additional revenue came directly from the new AI spending. That doesn't mean Meta's strategy will fail. Meta may still become one of the biggest winners from AI. The company has billions of users and one of the strongest advertising systems in the world. But today, investors are being asked to accept a large amount of spending before the full return is visible. At the time of recording, Meta was trading at around $595. My fair value today is around $615, and my 12 months base target is around $670. At this price, Meta looks close to fairly valued in my model. It's trading slightly below my fair value today and has some upside to my 12 months base target. But the margin of safety is still limited because the valuation depends heavily on returns from Meta's enormous AI investments. Meta stays on my watch list. The stock isn't overvalued in my model, so I may decide to add it to my portfolio. Follow the next public portfolio videos to see what I decide. Meta showed how quickly heavy AI investment can put pressure on cash flow, but Amazon had an even more extreme cash flow result, and its stock jumped by more than 15%. That was probably the most surprising market reaction for me. So why did investors react so differently? The answer is AWS. Amazon's total revenue grew by 20% to $200.6 billion. Operating income grew by 43%. But the most important number was AWS growth. AWS revenue increased by 37%. In the previous quarter, AWS grew by 28%. And this was its fastest growth in 18 quarters. So AWS wasn't only growing, its growth was accelerating. That's exactly what investors want to see. AWS revenue reached $42.2 billion, and AWS operating income increased from $10.2 billion 1 year ago to $16.6 billion. So the cloud business is growing faster and producing much more profit. Amazon also said its AI business inside AWS had passed a $25 billion annual revenue run rate. Its custom chip business also passed a $25 billion run rate. These are no longer tiny experimental projects. They are already becoming large businesses. And Amazon says a lot of its future cloud capacity is connected to demand that already exists. This matters. Amazon isn't only building data centers because AI sounds exciting. Customers are already asking for more computing power. But there is still a real cost. Amazon increased its investment plans again. Its free cash flow for the last 12 months moved from positive $18.2 billion 1 year ago to negative $7.6 billion. The main reason was much higher spending on property, equipment, and AI infrastructure. So yes, Amazon is using a huge amount of cash, but the market accepted it because AWS growth is already accelerating. Investors can see a more direct link between the spending and the new revenue. That is something Meta couldn't show as clearly this quarter. Amazon proved that the market can forgive weak free cash flow when growth is accelerating, profit is increasing, and future demand is visible. But that still doesn't mean Amazon is attractive at any price. At the time of recording, Amazon was trading at around $277. My fair value today is around $220, and my 12 months base target is around $240. At this price, Amazon looks clearly overvalued in my model. The report was strong, but the stock is already trading well above both my fair value today and my 12 months base target. So despite the impressive AWS results, I don't see an attractive entry at the current price. Amazon stays on my watch list. The report made the business look stronger because AWS growth accelerated and cloud annual profit increased, but the price still includes very high expectations for future growth and returns from the current investment cycle. So what did this earnings week really show? AI spending alone is no longer enough. The market wants to see a clear path from investment to revenue, profit and cash flow. Microsoft and Amazon show it that path more clearly. Meta still needs to prove that its much higher spending can create the same financial return. Personally, I would rather miss part of the upside than buy a stock only because everyone is excited after earnings. My goal isn't to own every great company immediately. My goal is to build the portfolio step by step and avoid paying a price that requires everything to go perfectly. That's why I don't own any of these stocks today, but all three stay on my watch list. Microsoft is an exceptional business, but the stock is already above my 12 months base target. Meta is the closest to my fair value today, but its future returns still depend heavily on AI spending. And Amazon delivered an excellent report, but its stock is the furthest above my fair value today. So based on my models, Meta is currently the closest to a reasonable entry price, but close to fair value is not the same as having a large margin of safety. I am not promising any purchase. If one of these stocks becomes attractive enough, you'll see the real transaction in my public portfolio updates. So follow the channel and especially the public portfolio playlist if you want to see what I actually buy, what I avoid and how the portfolio changes over time. And now I have a question for you. Which company is getting the best return from its AI spending today? Microsoft, Meta or Amazon? And which stock would you buy first at its current price? Write your answer in the comments, I'll reply to everyone and we can discuss it there. And if you missed the previous earnings week video, I analyzed Alphabet, Tesla and Intel after their latest reports. One of them moved closer to my buy price. The other two still had much more to prove. I'll leave that video on the screen for you to watch next. And of course, if you don't want to miss my portfolio updates or future market research videos, don't forget to subscribe and turn on notifications. This channel is about building a real portfolio over time. Deposits, ETFs, individual stocks, mistakes and decisions. Study investing, apply what you learn and grow your capital. And always remember that we are here to make money. Everything else is just poetry. I am DP and this is Durable Profit.